We're officially in a recession. My name is Sylvan J. Rahman. Welcome back to Intentional Wealth. In today's video, we're going to get into what the definition of a recession is now that we're officially in a recession. Ugh, that sucks. We're also going to get into what is this doing to housing prices currently, what it might do to housing prices in a year from now, and who this really might affect if this recession continues longer than we expect. First, go ahead and subscribe to the channel and click that bell icon so you're notified every time we release new content. A recession is defined as 2 consecutive quarters or 6 months of an economic slowdown. Well, it hasn't even been 4 months yet, and we're already calling this a recession officially. Well, what happened was the National Bureau of Economic Research came out and stated that we're in a recession, officially in a recession. And this is why. They stated that the US economy got hit so hard in the beginning months that it's going to take us way longer than 6 months to actually recover, even if the recession is a short recession. That basically means that a referee stopped the fight before the fight could even finish. Now, I could have been a contender, but not the contender that you think. I'm talking about the International Federation of Competitive Eating. Yes, Major League Eating. Look it up. It's a real league. Could have been a contender. And see, this is the thing they got wrong. We didn't have an economic slowdown in March going into April. We had a total standstill. And this is what I mean. Because of the pandemic, everything was shut down. And because everything was shut down, people couldn't go to work and they couldn't get paid. And because they couldn't get paid, they couldn't go out and buy the stuff that they wanted to buy. And even if they did get paid, they still couldn't go out and buy the stuff that they wanted to buy. And that means that there's no money flowing into the economy. And that's why we had the federal government come in with all these bailout packages. Now you're probably wondering, well, the stock market has rallied, so that's fine. But the stock market also got bailed out by the Federal Reserve and the federal government, just like the banks got bailed out in 2008. So it really doesn't change anything, does it? So now what does this all mean for housing prices? Let me know what you think. Is this recession going to be less than 12 months long, or is this recession going to be longer than 12 months? Comment down below and let me know. About a month ago, I released a video called Housing Market 2020, which is a little different and talks about late mortgages, forbearance, and foreclosures. So if you want more detailed information on that stuff, watch that video after you're done watching this video. This recession has actually affected home prices, but not in the way that you would think. Home prices have actually gone up during a recession. How is that even possible? Well, if you rewind back to before the pandemic happened, you'll remember that there was already a short supply for the buyer demand on the market, creating this environment of steadily increasing prices. Now fast forward a little bit, when the pandemic happened, almost 20% of home sellers took their houses off the market because they were scared of buyers walking through, creating even a higher demand. Now fast forward a little bit, the Federal Reserve steps in to boost the economy and drops the interest rates down to 0, creating even a higher demand. And in April, we actually saw the highest monthly rise in home prices compared to the previous 24 months. Now, how does this affect you? Well, it's 2 sides of the same coin, and it depends if it's good news or bad news for you, because it's good news if you're trying to sell a home, because you're probably going to get more than you asked for. But if you're trying to buy a home, it's probably going to be harder for you to find your dream home at the price that you want. So what does this all have to do with the future? And what is the future outlook? So if we're in a recession, what does this mean for real estate prices in the future? Well, actually, nobody knows. Will it continue to rise or will it continue to fall? We know one thing for sure is that it will fall at some point. It's just a matter of time. But when? Well, Zillow and CoreLogic have come out and said that they expect real estate prices to fall by April of next year by 1.3 to 3%. Now, will that happen? Who knows? You're probably thinking, well, the stock market has already rallied, so that means home prices will continue to grow along with the stock market. Well, that's not necessarily true. The stock market reacts differently in speed versus the real estate market. Case in point, back in 2008, the stock market started to drop and pretty much bottomed out by 2009. Real estate started to crash in 2010 and pretty much bottomed out in 2012. By then, the stock market had already recovered. The reason for this is the stock market reacts fast whereas the real estate market is slow to react. And because processes within the real estate market take a longer time to happen, such as foreclosure. And if you'd like to know more about foreclosure, watch the video I released last month called Housing Market 2020, Late Mortgage, Forbearance, Foreclosure. Even if the Federal Reserve keeps interest rates at 0%, I still think it's possible for us to see at least a slowdown in the real estate market, if not a decline. And we have to remember that in order for that to happen, we need to see a shift in supply and demand. And that shift in supply and demand is going to come from, one, the banks, and two, real estate investors. Yes, real estate investors. Let's deal with the banks first. The banks are already making it harder for people to borrow money because they're tightening their lending practices. That means that if you were able to get approved for a mortgage last month, that doesn't mean you're going to get approved for a mortgage next month. And that is where the demand is going to start dropping. And that's going to slow the increase in real estate prices. Now, real estate investors. You have to keep in mind that if you're a homeowner and can't afford your mortgage, you have forbearance going on right now. And if you're a renter, then you have pretty much a moratorium on paying your rent and getting evicted out of your apartment. But where does that leave the real estate investor or the landlord that has tenants that can't pay their rent? Honestly, real estate investors don't really have any protections right now in case a renter can't pay their rent. And if a real estate investor can't pay their mortgage on a monthly basis, they're going to either have to sell their property or worse, they're going to get foreclosed on. And that is where the supply is going to come from. So now as you see demand dropping from banks and you see supply coming in from real estate investors, you're going to see this slowdown in the real estate market, if not a total decline. And I don't mean that it's going to be a fast decline or a sharp decline or anything like that. We're just going to see a decline in housing prices. And that's it. Now, when is this all going to happen? Well, we don't know. Right? It all depends on when people can go back to work. The longer that people stay out of work, I think we're going to see that shift happen sooner. But if people get to work even faster, then we're going to see that shift happen a little bit later. Now, you're probably thinking, well, all we need to do is get businesses open and get people back to work. No, that's not how it works. You're probably thinking that in order to save the real estate market from slowing down, we just need to open businesses and get people back to work. That's kind of true, but it's not going to happen. And there's a two-part reason to that because it's two parts. You need to reopen businesses and get people back to work. First of all, you need to consider there's hundreds of thousands, if not millions of businesses that are closed right now. And even if we can get businesses open, there's still a lot of businesses that are not going to make it and not going to be able to reopen. You have to consider that in the past few months, you've had 4 major companies that have already filed for bankruptcy. What do you think that's going to do to medium-sized businesses, let alone the mom and pop businesses? Some of them just won't open, and this is the sad truth of this whole situation. In a perfect world, even if we were to be able to get 100% of these businesses open, you have to remember that when they reopen, they're not going to make the same type of revenue that they were making before this whole pandemic started. See? And because they're not making the same type of revenue from day one when they reopen, they're not going to be able to hire 100% of their workforce back. And that is the two-part problem. We're not going to be able to open all of the businesses, and we're not going to be able to hire 100% of the workforce back. And that is what is going to cause this whole problem for real estate investors. Because if people can't get back to work, then they're not going to be able to pay their rent. If you like what you've seen here today, then go ahead and subscribe to the channel, like and share the video, and follow me on Facebook, Instagram, and Twitter, and comment down below on what you think is going to happen in the future.